Hi there guys, Shingirai here again with another update on portfolio performance over the past week. In what many would know was a relatively somber week for equity trading, we'd see returns ranging from CBAM 1v2 returning 0.02% down to CBAM 5 returning minus 4.41% on the 1 week basis, and that's been largely in line with global equity markets, which have been down more than 5% across China, Europe and the United States on the back of that sell-off in global financial stocks after we saw that announcement of closure coming from Silicon Valley Bank. And also just in this week's trading, we've seen some weakness in European banks through Credit Suisse, raising about $60 billion of market value in 1 day of trading and being suspended from trade. And here what's basically happened is that there has been a bank run from some of these banks which hold larger depositor money, which would normally tend to be startups and business accounts. And really, after we saw examples coming out of Silicon Valley, failing to honor client withdrawals for operational costs or ad hoc expenses for running a business, investors really beginning to flee and flock to the larger banks, large commercial and retail banks, which have been perceived to have high levels of liquidity. As I highlighted earlier, detractors from performance, as you'd expect, would be our equity positions across Europe, Bailey Gifford, Columbia Threadneedle China, and LNG Global Thematic, all down more than 6%. In that contagion effect or knock-on effect coming from that sell-off of global financial stocks. But then again, as I highlighted earlier, stocks across Europe, China, and the United States also down more than 5% on the 1 week basis. Looking at contributors to performance, really supporting the lower risk portfolio, we did see that longer duration government bond positions across LNG All Stocks Gilt Index and also Vanguard European government bonds and Vanguard US government bonds, really supporting those positions as perception that these large pullback in the equity markets would lead to a more sort of slower rate hike course for central banks, or rather leading to a lower terminal rate expectation for central banks as well, effectively bringing down yields, and which acts as a tailwind for longer dated duration government bonds, all up more than 2.78% on the 1 week basis. Switching over to a quarter to date basis, on the back of the news of the sell-off of last week, we would see that risk-off sentiment, which saw CBAM high-risk portfolios outperforming low-risk portfolios, begin to reverse somewhat, with returns now ranging from our lower-risk portfolio, CBAM 1v2 returning 1.82%, down to our highest-risk portfolio, CBAM 5 returning 0.08% on a quarter-to-date basis. We continue to see that rebound from European equity coming into the quarter after that sharp derating of 2022, and that would see our Pictet, Allianz and Bailey positions, which are majority European equity, up more than 4% on a year-to-date basis, and that would signify a recovery of about 20% up from the one-year lows that we saw from European equities. And then moving on to detractors from performance, we saw some headwinds there for Equity Indian subcontinent position on the back of some concerns around growth and also just aggressive rate hikes from the Reserve Bank of India in an attempt to somewhat contain inflation within the domestic economy. As highlighted earlier, that financial sell-off in the financial markets really affecting our JP Morgan US equity income position, with both the hedged and unhedged positions down more than 5%. But then again, I'd note here that these positions had done relatively well with that value bias and overweight towards financials. Both these funds would hold about 20% allocation towards financials, which would obviously have been a headwind on the week that we just went through. Expectation has now moved. Looking forward to this week's announcement coming from the European Central Bank around their interest rate decision, where we're looking for a 50 basis point rate hike. Then in the next week, looking also forward to the US Fed, where the markets are broadly expecting again another 25 basis point rate hike in light of the events that have been unfolding in markets currently. We continue to monitor these and other developments on an ongoing basis, and thank you very much for your time.